Hey, everybody. Welcome to the universe. It's October 9, 2020. I'm Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. We do this every month on the second Friday of the month, noon Pacific time. You can listen in online through CalCPA, which is what you're doing right now, or you can watch the show later on YouTube when we get around to posting it, which is not too, we don't delay much. There you go. This month's topic is solving international tax problems with treaties. So treaties are kind of a parallel tax universe to the Internal Revenue Code. And this month we're going to talk about how do you use an income tax treaty to alter the tax result for one of your clients you're preparing a tax return for. The speaker is moi, and let's launch into this stuff. So the general approach is a three-step approach at a very high level, and you'll see how it rolls out over the course of the presentation. The first thing is you're looking for, you've got a human on the one side, and you've got an item of income on the other, and you put one in each hand, and you're going, huh? I know what the tax result will be in the Internal Revenue Code, but can I alter the tax result for the better using an income tax treaty? And in the real world, we all sort of do gratuitous hand-wavy stuff at the existence of income tax treaties and claiming tax treaty benefits and all of that stuff. But really putting it into practice and actually figuring it out, does it really truly work? And if it really truly works, how do I make it happen? That's what I'm going to talk about today. So the first step is just looking at the income item that you've got in one hand and saying, can I alter the income tax results for this income item? The second bullet point is, well, assuming that the income item can be taxed at a more favorable result than the Internal Revenue Code, can this actual taxpayer take advantage of that? So it's more about the human. And then finally, how do you claim the tax benefit? How do you claim that the Internal Revenue Code result does not apply, but the income tax treaty result applies? That's all about the IRS and all about paperwork. So that's what we're going to do today, talk it all the way through until the paperwork on the income tax return, which is Form 8833, and possibly companion withholding tax paperwork, Form W8BEN. I'm going to look at three different scenarios, and it's going to be a relatively simple sort of situation just so you can see what's happening and we don't spend a lot of times in the weeds. Imagine somebody living in Thailand, and this somebody has an IRA, and there's a distribution from the IRA to this somebody who's living in Thailand, and we're going to say, what is the tax result in normal life, and what is the tax result using the income tax treaty between Thailand and the United States? And we're going to look at three different kinds of humans: a U.S. citizen who's living in Thailand, a green card holder, aka resident alien of the United States living in Thailand, and a Thai citizen and resident who's a non-resident alien for the U.S. tax purposes. So for this last one, just assume it's somebody like they were living here in the United States and working for many years, accrued some money in a 401k, quit the job, returned to Thailand, rolled the money out of the 401k of the employer into an IRA, and now it's time to take distributions from the IRA. So that would be a typical situation. So let's just think about these three things. And I chose Thailand specifically because it has a relatively simple treaty, and so it's easy to understand and easy to follow what's going on. First, let's look at the income and look at the Internal Revenue Code and how does an Internal Revenue Code think an IRA distribution should be taxed. Well, first things first, a distribution is included in the taxpayer's gross income, and it doesn't matter whether you're a U.S. taxpayer, citizen or resident alien, or whether you're a non-resident alien. The second thing is, if there's a distribution to a non-resident alien, there's tax withholding. The default rule is 30%. And of course, for everybody, there's the possible early distribution penalty if you take out the money too early. And that penalty is a percentage of the amount of taxable inclusion in gross income. So this is ABC stuff that we've all seen 100 times on tax returns. Tax treaty. So tax treaties are between two countries, so they're a pair. It's not like a whole bunch of countries, 50 or 60, join in together and sign a treaty. Income tax treaties are bilateral, so United States and Thailand, United States and Japan, United States and France, things like that. Every treaty is going to be slightly different just because that's the way they do it. But here's a typical result. It's typical in U.S. income tax treaties with other countries that pension distributions are going to be taxed in the country that the recipient lives in and not the source country. So taking that typical result here, we would expect to see that the country of residence, Thailand, would have the primary right to tax this income tax, this IRA distribution, and not the source country where the IRA is, namely the United States. And if this typical result holds true, this means that for U.S. income tax purposes, the income tax treaty says this individual has zero gross income from the IRA distribution. And furthermore, if this recipient is a non-resident alien, withholding is tied to the amount of gross income inclusion. So if income is zero, then we would expect withholding to be zero as well. And since the early distribution penalty is a function of the amount of taxable income from this distribution, a percentage of zero is always zero. So we don't have any problems. So two very different results, fully taxable for U.S. tax purposes, or typical plan is no tax for U.S. tax purposes. How do you figure out which one is going to apply to you? Well, first, let's look at what is an income tax treaty. The way these things work is the boffins at the State Department go and negotiate with their counterparts in another country, and they negotiate a treaty. And it just happens to be about tax matters, and so the Secretary of the Treasury and their boffins get involved with the technical details. But this is a bilateral treaty, just like any other treaty between the United States and another place. It gets approved by the Senate, and therefore it is federal law, and it's of equal weight and importance with the United States Code. Title 26 of the United States Code is the Internal Revenue Code. So what you have here are two federal laws having to do with income tax, both of equal stature. And how do you know which one to apply? Well, here's how it works. The Internal Revenue Code is the one that applies by default, automatically always. Treaties can be applied by the election of the taxpayer if the taxpayer chooses to do so. So an income tax treaty and the federal income tax law decided by way of what the treaty says, it can never be imposed on you by the Internal Revenue Service. You can only choose to have it or choose not to have it. So you're always going to choose if it makes better, and if it doesn't make life better, you're just going to stick with the default rule in the Internal Revenue Code. There are a lot of situations where there's ambiguity about which comes on top of the giant anthill of life, and we're not going to go into that because today's situation is relatively clean, but you can get into a lot of angels dancing on the head of a pin kind of discussions when you're talking about income tax treaties and how, what kind of weight and deference, do you apply versus the Internal Revenue Code. So here's my handy dandy little diagram, just so you can see the flow and what we're going to be doing for the rest of the presentation. First thing, we're going to talk about income. So that's steps 1, 2, and 3. And then we're going to talk about the person. So income. Hey, the treaty works for the IRA distribution. Next, we're going to talk about eligibility, saying, hey, I'm one of the people that the treaty allows this, better tax result to work for. And that's steps 4 and 5. And finally, we're going to say, well, what does the IRS want to see from me to prove that I'm entitled to this better tax result? And that's steps 6 and 7. And here are, in words, what the little boxes say. We're going to go first and find things, because if you're just starting from scratch and you don't know where to look, you have to get into the body of the treaty as quickly as possible. So there are these things that the IRS publishes called the tax treaty tables. And there's a hyperlink at the back of the slide deck for where you can find this on the internet. So you're going to go to the tax treaties, and you'll see an example of a page in a second, and you're going to find the type of income you want, and it's going to reference you to the particular article in the treaty that applies to it. And it's also going to give you what the treaty says in terms of U.S. tax on that income type. So, all right, so that's more of a finder thing. Then you're going to go read the treaty, and there's going to be a little paragraph, and sometimes it's not so little, that explains what the result is going to be. It may be impenetrable or it may be understandable, but in either event, you're going to go read the technical explanation, because this is a long rider that goes along with where the State Department explains what the hell's going on with this treaty. All right, so that's the first step. The income works for you. 4 and 5, these are the two limitations that say whether you as a human are allowed to claim those beneficent tax results in 1, 2, and 3. 4 is this thing called limitation of benefits provision, and we'll talk about that. That's to prevent treaty shopping, which is abused in corporate situations, but not in humans, so it doesn't really worry us here. And then the saving clause, which is Uncle Sam's way of saying, I don't give two poops about this treaty. I'm going to tax my citizens and residents the way I want to. Treaty be damned. And then 6 and 7 are the paperwork. Form 8833 is an income tax form, and Form W8BEN is the withholding form. Let's go. All right, onward to income. First, this is the finder step. We're going to use the tax treaty tables to find out exactly where in the treaty we're going to find the answer that we want to find and see if it applies and whether it's better than the Internal Revenue Code. So here's a little excerpt from the tax treaty tables. You can see in columns, the columns have the type of income, and then the rows have the different countries, 60 plus or whatever number of countries we have income tax treaties with. So Thailand has the big red box along that row. And at the top in the column, it says pensions and annuities. And so we have the intersection of those two. And in the circle, you can see there's a 0. So that tells us the expected U.S. tax result under the treaty is 0 U.S. income taxation. There's a little letter F, and that references footnotes. And you can see almost every entry has some letters after the number. Those references a whole deck of footnotes at the end of the table. And just for your reference, we don't care about the F, but the F says also includes alimony. So the same rules that apply to pensions and annuities will apply to alimony payments across border between the United States and Thailand. So that's how you find it. And then you see in the far right-hand column, it says 20 open parentheses 1 close parentheses, and that gives you the article in the treaty. So now you know where in the treaty to look for the specific reference that tells you how pensions and annuities and alimony are going to be taxed. So that's your finder tool. Next, we're going to go on to the treaty itself, and we're going to see what it says. So this is equivalent to pulling out the code and looking up a code section. So here is, wow, okay. Ignore the title on this slide where it says Article 4.1. It should say Article 21, 20, open parentheses, 1, close parentheses. So here is the entire part of Article 4, Paragraph 1. It says, subject to the provisions of Paragraph 2 of Article 21, Government Service, pensions and annuities, and other similar remuneration, can never say that word, paid to a resident of a contracting state in consideration of past employment shall be taxable only in that state. So I bolded those words, shall be taxable only in this state, because it gives us our first clue that something good might be happening. Instead of being taxed in two places, we're only going to be taxed in one, and we like that. And you can see that the prose, if anything, is worse than the Internal Revenue Code. So here's my little table that helps you break down how people in the diplomatic corps speak and think and write, and try to translate it into English. So starting at the top, subject to the provisions of paragraph 2 of Article 21. This is same as in the Internal Revenue Code. It says, except as otherwise provided elsewhere in this title, and all, those kind of exceptions. This one just says, hey, if you're working with a government pension, go look at Article 21 of the treaty instead of Article 20. So easy peasy. That doesn't apply to us. Now, these next ones that are highlighted kind of in an orangey yellowy color, these are items I'm going to talk about in future slides, but let's just talk about what they mean here. Pensions and other remunerations. So our question is an individual retirement account a pension or similar remuneration? I don't know. We'll determine that. The next thing is pensions or other similar remunerations paid to a resident. So what does resident mean? Of a contracting state. Well, in a bilateral income tax treaty, the contracting states are the two countries that are signing this treaty, and namely the United States and Thailand in this case. And if you want to take all the mystery out of life, ignore the fancy word treaty and just treat it as this is a contract, and is a contract between governments. That's what a treaty is. And shockingly, countries break treaties all the time, which just means breach of contract. And what's the other party going to go do if someone breaches the contract? Not much. All right. So in the contracting state, we know that's going to be the United States and Thailand. In consideration of past employment, this one I submit to you is just filler and BS. Every pension I've ever seen, you only get it because you were employed. You don't get it for any other reason. Because you were a nice boy? I don't think so. You don't get a pension just because you were a nice boy. You get it because you worked. And then the result shall be taxable only in that state. And so we're going to figure out what that state means. But what it really means is the recipient's country of residence. Now, having looked at what's equivalent to the Internal Revenue Code in the treaty, let's look at the technical explanation. A technical explanation, it's not like the regs as such. It's more like an IRS notice or something, just administrative flatulence that just explains what's going on here. And it's non-binding, but it guides you and helps you a lot. So you find the technical explanation and you cross-reference to the article that you're reading, and you see if they're a little bit clearer in what's meant. And you can see that I'm unimpressed by the prose writing skill of the people who write these things. You'll find them difficult, let's just say, and I find them difficult. So here is the phrase out of the technical explanation of the USA/Thailand treaty. And you can see what's useful is they've given you kind of a hand-wavy definition of what it means, pensions and other similar remuneration. But then they've started to tick down. So for the United States, this is what we mean. Bing, 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 bing. And hey, presto, we see the magic words, individual retirement accounts. So now we know that we're bulletproof, and we know that if we have a distribution from an individual retirement account, it's the kind of pension and other similar remuneration that will qualify for taxation benefits under Article 20, paragraph 1. So this is really helpful, particularly I found it helpful for United States/United Kingdom situations where both countries just have Yeah, a whole menagerie of little beasties for retirement accounts, past and present. And you look at it, you say, I wonder if this one's going to be okay or not. And you can look at the technical explanation and you can usually get an answer. So, as a result of looking at the technical explanation, we've come to a conclusion yeah, we're going to be safe. And IRA is going to be one of these pensiony looking things that will be covered by the income tax rule under Article 20, Paragraph 20, Paragraph 1. So, achievement unlocked. The next thing down is this rule applies to a resident of a contracting state. So, a contracting state will be United States or Thailand because of those are the two parties to this contract, namely the treaty. The two governments are. And so the person must be a resident of one or the other. So, how do we prove that a person is a resident of Thailand? Because that's what we want to do. We want to make sure that this person is a resident of Thailand, because if the person's a resident of the United States and the treaty says tax the country of residence, we know the Internal Revenue Code applies and we're not going to waste our time using the treaty. So, how do we prove residence in Thailand? So, Article 4, Paragraph 1 defines resident for purposes of the income tax treaty. So it says briefly that you look at the laws of wherever that person is and figure out under the laws of that country, is that person considered a resident for tax purposes? And that's why under the laws of that state, so you look at domestic laws, is liable to tax, and that means income tax. And here's the technical explanation, which just amplifies it a little bit. And you can see there are a bunch of different possible reasons why a country might assert that an individual is a resident for income tax purposes. Domicile, residence, citizenship. Place of management is for corporations, place of incorporation is for corporations, and other similar criterion. Any other similar criterion. So that would just be the hand wavy stuff that tax law routinely has. So, bottom line out of what you read here is just you saying, I need to establish somehow that this person that I'm dealing with is an income tax resident of Thailand if I apply domestic Thai income tax law. So, if this person is filing an income tax return in Thailand as a resident, achievement. If there are other ways that you can do it, maybe not so much. So this is a practical thing, and you're going to have to decide whether you fit in this or not. Can't help you, and that usually means talking to your client in Thailand and saying, what do you think? And maybe you have to hire somebody in Thailand who's a tax expert there to say, is this person a resident of Thailand for income tax treaty purposes? But let's just assume that it's an easy peasy thing. This person's definitely a Thai resident. Next, the filler language in consideration of past employment. We're going to skip over that because we don't care, because it doesn't add anything to our analysis. And then the conclusion shall be taxable only in that state. And that state, if you read the prose, is a back reference to the most recent use of the word contracting state, which is the country of residence of the taxpayer. So if all of these things are true, and so far they are, we now know that Article 20, Paragraph 1 of the Income Tax Treaty between the United States and Thailand says Thailand is the only country that is allowed to tax an IRA distribution, which means that the United States cannot tax it, which means the IRA distribution is not included in gross income on the tax return of the individual at all. So, onward, this is a good result. We know that we're going to get a result that we like. Taxation in Thailand, no taxation in the United States. Now let's see if it will work for the type of taxpayer that we have in front of us, namely a U.S. citizen, a U.S. resident alien, or a non-resident alien and fully Thai taxpayer, no connection with the US at all, except having ownership of this IRA in the United States. The two barriers to success are these two clauses in every treaty that the United States has with every other country. There's a limitations of benefits clause, and there's a saving clause. And you're going to find them in every treaty. You're going to find them in different places. Unfortunately, there's no consistent numbering of treaties from one to the next, but guaranteed these two things will be there. So let's look at these two clauses at which ones will work to disallow the treaty benefits. For a non-resident alien, the limitation of benefits clause is going to be the barrier to applying the treaty, meaning if the limitation of benefits clause says this person is not entitled to use Article 20, Paragraph 1 to reduce U.S. tax to zero and get taxed exclusively in Thailand on an IRA distribution, it's game over. The saving clause is not going to apply to non-resident aliens because at a very high level, hand-wavy level, the saving clause explicitly applies only to U.S. citizens and U.S. residents. So since a non-resident alien is by definition not a citizen, they're an alien, and not a resident, they're a non-resident, the savings clause never matters to a non-resident alien. But for a U.S. citizen and for a resident alien, you're going to have to jump through both hoops in order to qualify that person to take the tax benefits of Article 20 to zero out the income tax in the United States and make the entire IRA distribution taxable only in Thailand. So we talked first about the limitation of benefits rule. Here it is. This is just an excerpt, but the idea here is the treaty can only be used by certain types of people. And the types of people who can claim the treaty benefits must be resident in one of the countries, or perhaps both. You know, for example, if you're a U.S. citizen and you're living in Thailand, you are a resident of both countries because you're living in Thailand and they have residence-based rules, and you're a, quotes, resident, close quotes, taxpayer in the United States because you have citizenship. But the treaty says the limits of the treaty are limited to people who live in one or both of these places. And after the ellipses, after individual, it says corporations, this, that, and the other kind of entities, and all of that. So they're looking at the residence not only of humans, but of entities. This limitation of benefits rule really doesn't matter much for individuals because it's relatively easy to figure out where this person is treated as a resident, but it's sometimes incredibly arcane for corporations and other entities. And what the limitation of benefits rule is trying to prevent is treaty shopping. And in the bad old days when I started doing this stuff, we would set up treaty shopping countries where we would take money, the taxable income in the United States, send it tax-free through a treaty benefit to, let's say, the Netherlands, because the Netherlands had very favorable treaties. And then we would use a different treaty to send the money from the Netherlands to another country, typically in the bad old days, the Netherlands Antilles, because tax benefits between those two countries were very good. And so what you would end up doing is sucking $1 worth of taxable income out of the United States by creating a tax deduction, dropping it into a corporation momentarily in the Netherlands, taxed at zero or a very, very nominal rate. And then that money would be in turn paid out to Netherlands Antilles Holding Company, taxed at zero because it was a tax haven. And this is the treaty shopping thing. And over the course of the last 20, 30 years, the government has pretty much closed all the doors on that. So that's why it exists. But for humans and doing tax prep for humans, you can't really do this. You can't pretend to be a resident of multiple countries at once. So it's not really going to be an issue. And so I'm telling you here, don't worry so much about the limitation of benefits rule when you're looking at tax treaty benefits for a human. But please do keep this question on your list just for drill, just so you know that every time you look at a treaty, you're first going to look at the limitation of benefits rule to see if your client qualifies. And then you're going to look at other parts too. And in our case, it's going to be the savings clause, saving clause. Next. All right. So we know, because we've assumed the facts, that in every case, we are going to have human beings who are unambiguously resident in Thailand. Therefore, the limitation of benefits rules are going to allow the use of the treaty by this person to deal with the taxation of U.S. source income. Let's move on now to the second of the two hoops. And these are the hoops that are going to, as I'm going to show you, create doom and gloom for our resident alien taxpayer and our U.S. citizen taxpayer. The saving clause exists because Uncle Sam has this worldwide taxation rule that says we don't care where you are on the planet, we don't care where your income is derived from anywhere on the planet. If you have the magic US passport, or if you are a resident alien, as defined in the Internal Revenue Code, we are going to tax you on worldwide income. So in order to protect that unique feature of the Internal Revenue Code, every treaty has hardwired into it the saving clause that allows this as a trump card over anything in the treaty, for specifically applied only to U.S. citizens and U.S. resident aliens. And there are going to be a few exceptions, and you'll see in the income tax treaty between the USA and Thailand, I'll show you what they look like. And so you're going to go through an analysis that looks approximately like this. Step one, does the saving clause apply to me? Oops, I've got a U.S. citizen. Oopsie, I'm dead. Oh, hey, wait a minute. Does any exception apply? Maybe. If the exception applies, continue. If the exceptions do not apply, you're dead. And you do a similar kind of analysis for resident aliens, for instance, a green card holder. At first step, saving clause applies. Yep, I'm doomed. Second step, does an exception apply? Yep, nope. If yes, I continue. If nope, there's still another avenue called the tiebreaker rule, and I'll talk about that later. So this is kind of how it goes, but at a first level of analysis, the saving clause is always going to doom you. Here's what the words look like in the Thai treaty. And look how it's phrased, the bold stuff. It says, a contracting state, the United States, may tax its residents, aka resident alien, but look at the little parentheses, and we'll talk about that in a second. But anyway, it can tax its residents, and by reason of citizenship may tax its citizens as if the convention had not come into effect. So what this means is that if you run up against this thing and you see that the saving clause applies, for that specific taxpayer, the convention does not exist. Convention is the magic word that the State Department uses for a treaty, which is really just a contract between two governments. And if the treaty does not exist, then Article 20, Paragraph 1 does not exist, and therefore you have to use the Internal Revenue Code to figure out how this IRA distribution is taxed. Looking again just at Article 4, Paragraph 1 of the treaty, just to see again what resident means. It's all these, hand wavy, all the different ways that you can be treated as a resident. Now, having seen the saving clause and what it looks like and what it says, let's now apply it one at a time to the three different kinds of people that we have: non-resident aliens, citizens, resident aliens. First, Non-resident aliens. This one's easy. The saving clause only applies to U.S. citizens and non-resident aliens, and therefore the non-resident alien is unaffected by the saving clause, and therefore the treaty exists, and it is not treated as it never came into effect. And because the treaty exists, Article 20, Paragraph 1 exists, and because Article 20, Paragraph 1 exists, the U.S. income tax rate is zero. That's how the sort of step-by-step logic works for a non-resident alien. For a U.S. citizen, the saving clause works like this, and it's always doom, it's never non-doom. Unless, of course, there's a hardwired exception in the, and we'll look at exceptions later. The saving clause, remember it says, forgive me, I'm going to zoom back to the full Article 4.1 here. It says, let's sort of substitute words as we go. So for those who are listening and not looking, we're on slide 35. For purposes of this convention, the treaty, the term resident of a contracting state means any person who, under the laws of that state, the United States, is liable to tax. Now, sorry, I wanted to see the saving clause. We're on 34. So, a contracting state, the United States, may tax, ignore the stuff about residence because we only care about citizenship, may tax by reason of citizenship its citizens. So the United States may tax by reason of citizenship U.S. citizens as if the convention had not come into effect. And you see the front end, it says notwithstanding any provision of the convention except paragraph 3. Paragraph 3 are the exceptions, and we'll look at those in a second. So what this means at first cut is unless you can find an exception in the saving clause, a U.S. citizen is going to be stuck with the Internal Revenue Code to compute taxation, even if living in Thailand. Here are the exceptions. And let's see if they apply or not. The first exception, A, looks initially promising. Say, hey, look at that. It refers to Article 20, pensions and Social Security payments, which we care about. And it says paragraphs 2 and 5. So we're going to have to look at paragraphs 2 and 5 to see if it works for us. And then B, none of those other things apply to us, so we're going to skip over those. So the only potential one we have is, will little paragraph little a apply as an exception to the saving clause, allowing a U.S. citizen to get zero tax on this IRA distribution under Article 20, Paragraph 1. And it won't work. The reason is because the exception we saw in the previous page says you can use Article 20, Paragraph 2. You can use Article 20, Paragraph 5 if you're a U.S. citizen and get whatever benefits the treaty says. But the exception does not refer to Article 20, Paragraph 1. So you're screwed. So the conclusion here is that a U.S. citizen living in Thailand taking an IRA distribution will have no ability to use the income tax treaty to be taxed exclusively in Thailand and not at all in the United States. As a practical matter, what that means is you're going to have to use the foreign tax credit rules to offset the double taxation problems. So you're not doomed. It just means you cannot use this method to create a single layer of tax on any particular dollar of IRA distribution. That's citizens. Citizens are screwed. Let's look now at resident aliens. Again, we look at this, and the top bullet is just the excerpt from the savings clause. A contracting state, the United States, may tax its residents. Note that the definition of resident is not as defined in domestic law, namely the Internal Revenue Code, but resident as defined in the treaty. Important, and you'll see it in a minute. As if the convention had not come into effect. So what this means is that if you look at Article 4, and you've got a green card holder, for instance, and you decide that Article 4 makes this person a resident as resident is defined in the treaty, then for that person, the convention has not come into effect. So if the treaty never came into effect, then Article 20, Paragraph 1 does not exist for that person, and therefore the Internal Revenue Code is your only way to figure out the income taxation results for that person. That person will be taxed in the United States and Thailand. So again, we're going to go through the same questions. Number one, can we find an exception to the saving clause? So we're going to look at paragraph 3 again, and we're going to come to the same conclusion. No exception applies. And then we're going to go down to the next one. Can we somehow manipulate the Article 4 resident status so that you're no longer a resident of the United States as, quotes, resident, close quotes, is defined in the treaty? So you're ignoring the Internal Revenue Code definitions, and instead you're looking to manipulate treaty definition of resident. And the way you do that is by using what's called the tiebreaker rules, which are in Article 4, which say if someone is treated as a resident of two countries at the same time, here's how we break the tie and decide the person is a resident of one country or the other. So here we go. The Savings Clause says people who are U.S. residents will be treated as if the treaty doesn't exist. Said that before. Article 4 allows U.S. residents to use the tiebreaker rules, which is what we're going to talk about, when you're a resident of both places. And the reason a green card holder, for instance, would be a resident of both countries would be that the Internal Revenue Code says you're a resident because you've got the magic visa, and Thailand says you're a resident because you live here. So two different measures under domestic law make you a resident, and Article 4 says you're a resident of two places, and here's how you break the tie. And slide 42 has the entire set of tiebreaker rules. And think of this like a giant pachinko game. You're going to drop a little ball at the top, and it's going to bounce down, and choose one path or another, and you're going to end up in one of two buckets at the bottom, either resident of the United States or resident of Thailand. So let's just drop the ball at the top and follow all the way down how the logic works. So let's start from the assumption it's a green card holder and living in Thailand. So the number of days of presence in Thailand make them a resident of Thailand. The green card makes the person a resident of the United States. It could also work that the person spent too many days in the United States under the substantial presence test. Same rule, but I'm just thinking green card to keep it simple. So let's look at the first tiebreaker. A, you are deemed to be a resident of the state, meaning the country, in which you have a permanent home available to you. So you own a home, you rent an apartment, stuff like that. Frequently, people will have homes in both places. So if you have a home in both places, you look to this thing, which is your center of vital interests, which is not unlike domicile. I mean, if you've ever had a beef with the franchise tax board about one of your clients lives in a post office box in Reno, and the franchise tax board begs to differ and says this person really lives in California, you're not too far off in trying to think about it. This is a really, truly what's life really like kind of analysis. So that's how you go. So where's your house? If you've got a house in one place, that's the story. So if this person is a green card holder, sold the house, gave up the apartment in the United States, and is living in Thailand for the while, has an apartment or bought a house, Thailand is it. End of story. And the tiebreaker rules say so. If they have, kept the house in the United States and it's open and they have a place in Thailand too, then in both places you have to look at center of vital interests. My guess is that somebody living in Thailand and working and doing whatever probably would have center of vital interest more in Thailand than the United States, but it could be a close call. I mean, let's say that you have an operating business that you own in the United States and you're going back and forth between Thailand and the United States, trying to build the business in Thailand. Where's your center of vital interest? Well, hard to tell. Where's your family? Well, what if they're with you? What if they're flying back and forth? What if you're single? All that sort of stuff. It may be ambiguous. And if it's ambiguous, we go down to B. If you can't figure out where center of vital interest is, or you don't have a permanent home in either place, so a nomad, for instance, then you're deemed to be a resident of the state in which you have an habitual abode. I always get confused about the silent H stuff and then a and an, but that's just me. So this is saying, where do you live normally? So, if you're just looking at things from a abstract view and you say, yeah, he's really living in Thailand, that's it. This may be clear, it may be ambiguous. If it's clear, you have the result of wherever you are. So let's again assume it's Thailand. If it's ambiguous, you go down to the next one. You say, if you've got this abode in both places or neither of them, then you're a resident of the state in which you're a national. So you look at your passport. So that's usually the defining point at which you can make a decision under the tiebreaker rules. Because usually people have one passport and not two. Not always. But if somebody has a passport in both, you do this fallback, D at the bottom, where you ping both countries and you say, hey, what do you think? Where do I live? I can tell you I've been doing this kind of stuff since 82. I have never done that. I'd have to be a damn fool to ask two governments to solve a tax problem for me. So as a practical matter, you're going to make a call on A, B, or C, and you're going to make a decision on which way you think the tiebreaker rules cut. You're going to file a disclosure on Form 8833, which is the form that you file when you say, I'm claiming some tax treaty benefits, and you're going to be done with it. And I've got to say that the number of times that a tax treaty position has been challenged by the federal government, in my experience, has been, knock on wood, zero. So assuming you've got reasonable facts in your favor, pick one of these, take the position on Form 8833 and be done with it. And I'm going to assume that in all of these cases, you're going to be able to take the position that Thailand is the place for this person. So assuming this is the case, for instance, we've got a green card holder. The green card holder has no home in the United States, but has a home in Thailand. Or the center of vital interests is in Thailand. Right? The green card holder got a job working in Thailand for somebody on a 2-year contract, took the whole family, rented out the house here on a long-term lease, moved to Thailand, is living in permanent location, either a leased apartment or something like that, or bought a house perhaps. And so really, truly, under the tiebreaker rules, the person is living in Thailand. You're going to make the election on Form 8833, and the effect of that is to make this person a resident of Thailand and simultaneously make this person a non-resident of the United States for income tax purposes. Note, important, it does not affect immigration status. So this green card is still valid in full effect, and USCIS will look at this person just the same as always, notwithstanding the fact that the treaty election has been made to be taxed as a non-resident. Now, I know that there's a lot of talk going back and forth, and I worry about it too. Says, what about when it comes time to renew the green card and you go to the USCIS and say, hey, by the way, I filed tax returns as a non-resident for a couple of years. This is evidence that you don't really intend to make the United States your home forever and ever. meaning you don't want to intend to be a permanent resident, and maybe in theory, USCIS could take that evidence of intent to live abroad as a reason to yank your visa. But I've talked to a bunch of immigration lawyer buddies of mine, and they go, and they don't really worry about it. So, you know, do with that what you will. I would put this on the checklist to talk to the client about before you make this election. But so far, knock on wood, this seems to work just fine. The final thing is put it on your checklist that if you are making this election to have a green card holder be taxed as a U.S. non-resident and a resident of the other country, for God's sake, be very, very careful about accidental expatriation. Because if this person has had the green card long enough, and there's an 8 out of 15 year test for that, and I'm giving you the citation there, Section 877E2, by making this election to be a non-resident for income tax purposes, that's a deemed expatriation, and the effect of that is a giant mark-to-market event throughout your entire balance sheet, which might be exceedingly unpleasant, particularly if the person is going to come back in a couple of years. So before you do this, take care. One of the saddest / hilarious ones that I had was a U.S. certified public accountant living in a European country, let's say, who was a green card holder and decided to do this for himself, and accidentally expatriated. So it can happen, even if you're smart. So all I can say is keep checklists. There's an interesting little piece about expatriation and this saving clause exception that you want to take advantage of. So let's say that you make this election and you're a green card holder, you make the election be non-resident, and you are now an expatriate. Or you're a U.S. citizen and you give up your citizenship and you expatriate. The treaty between the United States and Thailand says, guess what? For 10 years after this person ceases to be a U.S. taxpayer, either by way of treaty election to be a non-resident alien or by giving up citizenship, for 10 years after that, the United States reserves the right to tax that person as if he/she is a citizen or resident. Now, this is insane. And I don't have any specific authority for this, but pure logic and I hope common sense will persuade you that this does not apply. So if you look at the treaty and you see this and your hair lights on fire because you've got somebody like this who is now living abroad, has expatriated and wants to use a treaty to improve a U.S. tax result, let me tell you why I think this is just deadwood and you don't have to worry about it. So this 10 years after stuff is an after effect of the old exit tax law, Section 877, which went out of being in June of 2008 and was replaced then by Section 877 Cap A, which is the current exit tax law. And under the old exit tax law, the rule was if you give up your citizenship or green card for non-tax reasons, you're okay, and we're not going to impose any bad tax results, namely the giant mark-to-market event in your life. But if you gave up your green card or your citizenship for tax-motivated reasons, then we're going to impose the exit tax. And the old law, Section 877A, again, this is keyed to motivation, and were you motivated by tax reasons or not? It said, if you are motivated by tax reasons, then for 10 years, the United States tax system has a leash on you and can tax you under certain conditions. So this 10-year rule is a function of the old, now obsolete exit tax law. And if you look at the date of the treaty, you'll see that USA/Thailand treaty was enacted after Section 877A, but before Section, pardon me, after 877, so it was enacted before the new law came into being. So it reflected accurately the law of the time, but it doesn't reflect the tax law the way it is now. So I just conclude that it's impossible under current law for you to have a tax-motivated expatriation because motivation has nothing to do with it. The new rules are very mechanical. What's your net worth? What was your net income tax liability? Did you file your tax returns and pay your taxes and stuff like that? And your internal state of mind has nothing to do with it. So therefore, I would tell you, cheerfully ignore the deadwood if you find it in a treaty that you're looking at. All right. Finally, we're going to say, what do we do about paperwork? Let's recap where we are so far. We've gone through the first question. We've found the treaty provision that applies to the type of income that we're talking about, the IRA distribution. And then we looked at the technical explanation and we confirmed to our own satisfaction that an IRA is indeed a quotes pension, close quotes, to which the treaty applies. So now we're good. The income item is good, and we know what the tax result will be if we are successful, zero tax in the United States. And then we went through the process of looking at the type of taxpayer that we're preparing a tax return for, and we figured out that non-resident aliens are always easy peasy. They can just sail through and they can claim the treaty benefit so that the tax treaty will say zero U.S. income tax, distribution tax entirely in Thailand only. We saw that citizens are in bad shape. They're just doomed. And the reason is the saving clause. And we saw that green card holders are doomed or not. They are doomed if they are U.S. taxpayers, resident aliens, and the tiebreaker rules don't cut in their favor. They are not doomed, and they can claim the treaty benefits if the treaty tiebreaker rules say that they are treated for treaty purposes as a resident of Thailand and not the United States. So now let's move on to the paperwork required for those people who can indeed claim the treaty benefits. So this is for a non-resident alien or for a green card holder who is going to claim non-resident status using Article 4, the tiebreaker rules in the treaty. So, what kind of paperwork does the IRS want to see? Basic rule is tell us everything, right? Section 6114 little a. But there are exceptions to the rule. There's some things where the Congress has said, we don't really need to see the paperwork on everything. There's just some things that we want to see. So I've given you the citation to the regs and also the filing instructions for Form 8833 are really comprehensive, so they're good. But here's the fun part. If you don't file Form 8833, but you prepare your tax return as if you're taking the position allowed under the tax treaty, you don't lose the tax benefit. All you do, the worst that can happen is there's a $1,000 penalty. So, screw-ups aren't that bad. Still, you want to do the paperwork if it's required because $1,000 is $1,000, but you're not doomed. So that's cool. This is quite unlike other areas of international tax where, you didn't file Form 5472. Let's chop off your hand. So what's required? Here's one of the exceptions, and it applies specifically to pension payments. So you do not have to file a U.S. income tax return for this Thai non-resident alien saying my IRA distribution has zero tax. You don't have to do the Form 1040 NR with an 8833 attached because Regulation Section 301.6114-4, open parentheses, little c, close parentheses, open parentheses, Roman numeral 4, close parentheses, says so. We love it when we find clear, crisp answers in the code or the regs, which is not always, but when you do, it makes you happy. However, Form 8833 is always required if you are using the tax treaty and the tiebreaker rules to toggle you from resident status to non-resident status. And in that case, the green card holder is going to file a Form 1040-NR. You're going to bolt the Form 8833 to it to say, I'm a non-resident, and off you go. And you'll prepare the regular Form 1040-NR for that green card holder in the normal way. And the normal way means all the paperwork that would be expected for a green card holder, except that you calculate tax liability as a non-resident alien. So if this person owns shares in a Thai company, you're going to be doing the Form 5471. If this person owns shares in a foreign mutual fund, you're going to be doing 8621. But the good thing is you're not going to be flowing any income through these little things to the tax return and calculating the tax liability that way. So there's the citations for why you have to file the 8833 to claim non-resident status. Finally, we're going to deliver the Form W8BEN to the payor, because if you've got an IRA administrator who reflexively thinks withhold 30% on everything, the last thing you want is for a zero tax situation to force you to file a 1040-NR and claim a refund for over withholding. So you want to prevent the withholding at the beginning so you don't have any unnecessary paperwork. And you do this by filling in the W8BEN, and part 2 is where you claim the treaty benefits. So here's an example of how it looks to claim the treaty benefits on the W8BEN, which you're going to give to the IRA administrator anyway, because that's just part of their normal checklist for paperwork they want internally. So you're calling out the clause in the treaty, 20 open parentheses, 1 little parentheses, and it's saying zero claimed withholding obligation, and you're describing the type of income, IRA distribution. What this does is it gives the withholding agent, the IRA distribution, sufficient good cause for, in good faith, withholding zero and not being under the gun personally for failure to withhold by accident. If the IRA administrator has reason to know you're lying, it's a whole different deal. But this is going to solve the problem for you, and you're going to have zero withholding on that IRA distribution. In conclusion, here's my little table showing who can do it, and you can see the only people that can claim the treaty benefits and make the IRA distribution taxable in Thailand only are people who are neither Article 4, Paragraph 1 residents of the United States or U.S. citizens. Those are the people that are going to get to do it. And there are the 2 citations. You can find the table there. You can find all the treaties on the IRS website there. And there's the handy dandy disclaimer. And that's me. Email me if you have questions, and I'm done. Next month, it's going to be holding structures for U.S. real estate investments by non-resident aliens. In other words, prevent tax problems for non-resident investors before they happen. I'll see you next month, November 13, and thanks for listening. I'll turn it back to Rob.